Welcome to Investor's Guide. You're watching ET Now. I'm Faye D'Souza. Now, this is the show that helps you find investment products in the market by looking at what suits your needs. And I know we've had such a wonderful week at the stock market, and you're probably wondering how you should tweak your portfolio. Well, this is the advice, really. You do nothing. You grab a pen and paper and you write down the advice you get over the next half hour. But what we're telling you at this point is don't make any knee-jerk reactions. Take some time, see how this plays out. You don't have to do anything at all on Monday morning with your portfolio. Stick to your plan, continue your SIPs. But if you like, we will sit down a week from now once we've digested all of this information, and we'll give you a strategy of how to approach this market in an SIP sorted out, slow manner if you want to take advantage of a turnaround, if there is going to be one. On this show, however, we'll start by planning for a 41-year-old for his family's future. He's running out of time, but we'll tell him how to play catch-up. In our product review, we look at the Templeton India Equity Income Fund, and we'll tell you if it makes sense right now to invest in a startup before you invest in a mutual fund. All right, let me bring in Narendra Kumar, the CEO of Value Research and our in-house mutual fund expert. Narendra, thank you so much for joining us.
Thank you.
Let's get straight to our portfolio question. Vikram has written in, he's 41 years old, he has 2 children, and he'd like to save 40 lakh rupees for their futures and, of course, build a corpus for his own retirement. So he gets a monthly income of 40,000 rupees. I'm afraid he might have underestimated his retirement needs, but he currently has 2 policies, 2 ULIP policies from Bajaj Alliance that he bought in 2007. He wants to know if he should continue those policies. It's a term cover of 50 lakh rupees, 30,000 rupees in his PF account and 5.2 lakh rupees in fixed deposits. He wants to know if his investments are allocated well. Now, Narendra, before we get into his specific mutual fund investments, I'm worried about the money he has in fixed income, which is his fixed deposit and his PPF together. Should he re-look at his entire allocation?
Oh, he will be in for a nasty surprise because the way his portfolio is constructed, and some of his goals are fast approaching. His daughter's education will be 5-6 years away. If they go for after class 12th, if they get into serious education, which he just may not have enough money. Also, the way his portfolio is configured right now, it is just not poised for growth. In fact, all the money in fixed deposit is static virtually, because even if it's earning 8.5–9%, it is just matching the inflation, and certainly matching, not unlikely to match the inflation of the way education cost is going up. So he needs to do something urgently, and he needs to do a very comprehensive rejig.
But if you look at his allocation right now, Narendra, for the various goals that he has, obviously 5-6 years for his daughter's education, his son's education is at least another 10 years away. His own retirement is 20 years away. Should he have separate portfolios for each of these goals? And what should be the ideal asset allocation for each of these portfolios?
Ideally, yes, it should be separate allocation for all of this. And he should, work on some target. But the starting point here should be, one is all his current allocation. First is weeding out all the relatively unproductive asset or not so, good investments, so to say. And so, and as one good thing he has done is got a term cover of 50 lakh. He should quickly evaluate that if it is enough. If it is not, he should actually top it up or increase it depending on his requirement. And after that, he needs to completely overhaul his portfolio. Withdraw his ULIPs. If they are over 5-year-old, there is unlikely to be huge penalty by way of surrender charges, so that he can recover. Looking at his equity funds and looking at his ULIPs and this outsized allocation to fixed income, I think he should be 70–80% into equity, remaining in fixed income, and that too in a manner where he can make the effect a rebalancing of his allocation periodically without much of a problem.
Well, let's take a look at his mutual fund investments, Narendra. He has a very interesting list of mutual funds, and what I'm most concerned about with his list is the overlap. He has HDFC Prudence, Tax Saver and Top 200, which of course creates an overlap. He has Reliance Growth, but he has a diversified power sector fund, and we've all had several concerns about that fund. He also has Reliance Regular Savings Equity. Now, he has SBI Tax Advantage and SBI Magnum Tax Gain, which are both from the same fund house. Now, if you were to streamline this portfolio and get rid of all of the overlaps, how would you design it for him?
The portfolio for his son's education as well as his retirement, which is 15 years away, 15 years and more away, he should be looking at our growth portfolio or our aggressive growth portfolio. And for that, the important thing will be getting rid of all these sectoral funds. And some of the funds which he owns are part of our portfolio. And for his daughter's education, it will be very important to accumulate his savings into a balanced fund over the next 3-4 years and methodically plan his exit, because all the money will not, assuming that 10 lakh is needed for their education, that will not be needed on day one. It will be needed at some periodicity over the course of their education. So he should plan his exit accordingly. So if he has 3-4 years time to accumulate and then work towards 15-20% withdrawal thereafter from that portfolio, and that is the way he should approach it, which means that he can keep accumulating even while they are even while he is withdrawing periodically from that portfolio, and that should be our stable growth portfolio.
All right, so that portfolio is on your screen, Vikram. The good news is there is enough money in your kitty right now. What you need to do is to streamline the entire portfolio that you have. Take a look at all of it, put it together. Narendra saying use separate portfolios for your daughter, for your son, and for your own retirement. And if you have any more questions, of course, you can get back in touch with us. Let's take another question. LR Bhatia has written in. Now, he is retired. He's been investing 3,000 rupees and 5,000 rupees in the HDFC Top 200 and HDFC Prudence funds respectively. He wants to know if he should continue these investments, especially given the volatility in the stock market. Now, Narendra, we know that the next 3-4 weeks are going to continue to be volatile, at least. For investors like him, who's retired and he's worried about the volatility, should he be in these funds at all?
No, if he's worried about the volatility, he should not be in these funds. But at the same time, by now he would have understood that this volatility has been good for him. If he's accumulating for some time, if he looks at the investment values, it'll be substantially more, simply because equity is volatile. Volatility could be very injurious if you are likely, can hurt if you need the money in next 6 months and the market goes down substantially in a brief period of time. So if this is some money which you don't need, you can well assume that. But despite that, if you are generally very upset with this big ups and downs, ups you don't care, you like it, but big declines you don't like, you don't have an appetite, then consider a different thing altogether. Maybe put all your money into HDFC Prudence, or maybe HDFC Balanced, which is little more stable than the Prudence, which on the downside.
All right, so HDFC Balance would probably suit you better, especially because this sort of volatility makes you nervous. Let's take another question. D. Sharma has written in. She wants to invest in funds which have a major portion of their assets in government securities with a maturity period of 15 to 18 months. What are her options, Narendra?
Specifically 2 funds with reasonable asset, as well as portfolio maturity ranging between the time he's referring to, which is 15 to 18 months. The IDFC Government Security Fund short-term plan and SBI short-term gilt fund.
All right, on your screen right now are the funds that you had asked Narendra for. Remember, if you have any questions for Narendra at all about funds you have to invest in, write to us. Our email ID is on your screen. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. Narendra Kumar is with us as well, and it's time for our product review of the week. This week, we're looking at the Templeton India Equity Income Fund. Avan will give you a quick introduction, and then we'll come back and talk about it. Avan.
Thanks, Faye. This week, our fund in focus is the Templeton India Equity Income Fund. The fund aims to generate long-term capital appreciation by investing in Indian and overseas stocks with attractive dividend yields. The fund managed to beat the category average consistently, except for 2007. In 2009, the fund had a stellar run and clocked in returns of 104.2%, beating the category average by 27%. Like all dividend yield funds, this fund has had a tough run in the last year, and the stronger rupee has been a disadvantage to its international portfolio. But these funds are expected to recover with the market turnaround. So let's do some math to give you a better view. If you invested 1,000 rupees in this fund, you would have 25,090 rupees today. So should this fund be a part of your portfolio? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for that information. Narendra, when we talk about this fund, the last time you gave it 4 stars, it's down to 2 stars now on your website. But the thing about it is, A, it has not recovered as quickly as the rest of the dividend yield funds that were struggling along with it. Secondly, with 20% invested in the overseas market, it hasn't even shown that sort of a beta in its performance. What's happening with this fund, and do you believe we should give it more time?
The dividend yield funds generally, of all kind, have struggled. That is primarily because of the dividend yielding stocks, high dividend yielding stocks. They have turned out to be relatively lower growth, or they have actually slipped much more. So if we look at all the prominent dividend yield funds, they have struggled. And in the multi-cap category, this fund falls into the multi-cap category because of its average capitalization, relatively mid-sized or small-sized companies dominating its portfolio. But I would say that this fund one should not give up on this fund. It has been a relatively disappointing multi-cap fund, but I don't think it has wavered from what it aspires to do, and it has maintained its discipline. And on a full market cycle, I think that will prove its worth. Wait for some, investors should not give up on this fund. Eventually, investors question that what has been my total return, and on that front, it has been disappointing, but never, it has never been at the bottom. Of course, in very recent time, it looks like one.
Well, Narendra, in all fairness, if I had invested in any other dividend yield fund, I'd be better off right now. If I had so much as just invested in the Nifty ETF over the last 1 year instead of this fund, I'd be better off right now. So what justification is there to continue investing in this fund if I can just pull my money out and move it maybe to a more efficient fund?
If we look at last 15 months, this fund has struggled has not been able to beat Nifty and has fallen by 2-3 percentage points. But that is not substantial. If you look at 4-5 year return, if you look at the year before that, 2009, when it was able to beat Nifty by a wide margin of 8-9%. So one has to look at, it's very difficult to guess which segment of the market will do well. This strategy of being in a dividend yield fund could be very useful. Of course, this fund has suffered little more because of its 20-22% allocation to foreign stocks, which are completely out of favor. They are also hurt by the rupee appreciation.
All right, Narendra, finally, your star rating of the Templeton India Equity Fund, you gave it 4 stars the last time we talked about it. How would you rate it now?
I would rate it as, a notch lower, because this fund has not, it has slipped on a risk-adjusted rating scale. So I would give it a 3-star, but and I would not recommend investors to buy this fund. But I would say that, this fund is a promising fund, and one should wait, for the full market cycle to do a real evaluation based on return.
All right, so Narendra asking you to wait on this fund right now. Don't pull your money out. And of course, we'll continue to review it on a regular basis. So we'll keep an eye on this fund and its performance and how it continues to perform in this turning market. Let's move on to our hold or sell segment. Well, Aldrab has written in, Narendra, he's been investing in SIPs, in mutual funds for the last 4 years with an aim of creating a corpus of 50 lakh rupees in 7 years. He wants to know if his portfolio is on track. Now, he's investing an equal amount of money in all of these funds, 2,500 rupees every month. I'm going to take the first 2 funds together because this is a mistake we see in a lot of portfolios, HDFC Equity and HDFC Top 200 on the top of the list. If he has a 7-year horizon, should he continue both of these funds?
No, I would say that, he'll be better off by just putting his money in HDFC equity fund. There is a substantial overlap, and he just might have a false sense of, diversification. And given his time frame, that could simply be a better choice and more manageable.
The next one on his list is the DSP BlackRock Equity Fund, Narendra. How would you rate its performance so far, and should he continue investing in it?
No, this fund has been disappointing. In fact, most of the DSP BlackRock's equity fund has been disappointing relative to in their respective category. But things change, and one should carefully evaluate. It is certainly not the finest choice right now.
The next on his list is the ICICI Prudential Infrastructure Fund, Narendra. Of course, it has begun to recover a little bit, and there is a view in the market right now that infrastructure as a sector will recover, and these funds will recover accordingly. So for someone like him who's been holding an infrastructure fund, does it make sense to hold on to a point where it recovers and he makes some money on it?
Yeah, I think one should hold on to it only till the point it makes sense. And I think, things have turned around substantially for infrastructure funds, if not for the infrastructure or, in general in the economy. So I would say that he should just time his exit, because it's important for him to diversify, be passive about his investment, be into good funds.
In fact, that fund has returned about 8% in the last 1 month, so it makes sense to just take a look at your investment one more time. Next on his list is a Kotak 50 fund, Narendra. Continue with this investment?
Yes, he should continue with this investment. This is a very well-defined fund. This has been out of favor. The fund just didn't get it right on a couple of occasions in the down market. But things look quite improved for this fund. So he should carry on with his investment. Reliance
Growth is also on his list, Narendra. Would there be a similar recommendation on this fund as well?
Yeah, likewise, Reliance Growth was more disappointing, and the way it has done very well in recent times. And I think, this fund behaves differently in two kind of market. If one is pessimistic about the market, it might make sense to get out of this fund. But if one is optimistic about this fund, then optimistic about markets in general, about economy in general, which looks like the mood is changing, then this fund has turned around substantially, much better than most others. So he should certainly carry on.
Well, Narendra, I know how you always tell us that we should have a small portion of money in mid-cap if we're willing to take that risk. Now, he has 1/7 of his entire allocation in the Sundaram Select Mid-Cap. Now, granted, it's not the most nimble-footed mid-cap because it hasn't recovered as sharply as some others, but 30% in the last 1 year, 22% in the last 3 months, in line with the category. But is this what it means really when you tell us to have a mid-cap fund in our portfolio? Should he continue with this allocation?
Exactly. Last 2 years, 3 years, it has been very embarrassing to build a case around mid-caps. But this is the kind of thing which actually brings them on the forefront. And most investors, and it's very important for investors to diversify. So they should not be, because if you were owning a set of mid-cap funds only, and you saw them go down in value by 40-50% over the last 4 or 5 years, it will be extremely difficult for you to stick with your plan, carry on with your investment plan.
All right, so on your screen right now is a portfolio that Narendra suggests you do have. And of course, if you'd like to have us look at your portfolio, write to us. Our email ID is on your screen. I have time for one last question. Abhishek has written in, he began investing 5,000 rupees a month in the Templeton India Growth Fund 4 years ago. He's invested 2.4 lakh rupees so far, and it's gone up to 2.77 lakh rupees today. He wants to know, should he redeem the investment now because the fund has very poor ratings online, he says. And a lot of investors like Abhishek, they're going to be wondering if they're holding a slow fund, it would have recovered over the last 1 month. Should they take advantage of this opportunity and pull their money out?
Yeah, I would say that, in good market or bad market, if you get a conclusive sign that, this fund is unable to do well over a full market cycle or in a rising market, is not good. And Templeton India Growth Fund has been a disappointing fund for a long time. This fund is the only in the Templeton family of, equity fund that emphasizes value investing, and it hasn't got it right. So I would say, if you believe in value investing, you have some other options, very interesting and impressive funds to choose from. For example, the ICICI Prudential Value Discovery Fund, erstwhile, Discovery Fund. Now they have started calling it Value Discovery Fund to emphasize the approach they follow. Even Parag Parikh Financial Services, the only equity fund they have is very impressive and follow the same principles. Quantum Long-Term Savings Fund, likewise, is an impressive fund to choose from. So he should consider moving his money from here to one of those funds. If he happens to be in this fund because he believes in value, or he has heard or thinks value as an approach will be, rewarding.
So if you have a list of funds that you would like us to look at, send it to us. The email ID is at the bottom of your screen. Narendra, thank you so much for spending time with us this week and answering all of our questions. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We brought in Vishal Kapoor this week to answer all of your investment questions. Vishal, it's always a pleasure to have you on the show. Our first question comes in very interestingly from Rikit, who writes in from Bangalore. He's only 25 years old. He has a monthly income of 22,000 rupees. Now, he tells us he wants to invest 3 lakh rupees from his savings in equity of a startup company for good returns. He wants to know which companies he should invest in. So obviously, someone like Rikit, young as he is, wants to jump in with both feet. Vishal, do you recommend that he take that kind of risk, or should he start smaller?
Rikit, in your case, if I may say so, we have a bit of a paradox because you're beginning to invest and the asset class you're suggesting is actually almost on the extreme end of the risk curve because what you're suggesting is almost private equity into startup companies, which frankly would be very, very high risk. A modest way or a more balanced way to start would be to maybe try out a more balanced fund to, for example, which gives you a bit of exposure into fixed income as well as a fair amount of exposure into equity, provided you can tolerate that amount of risk first. The 3 lakhs that you want to invest may get you more capital appreciation through listed equity right away than in startup equity, which is unlisted, even if it is held for some amount of time.
All right, so one step at a time. Remember, Rikit, you have to learn to walk before you run. Well, Anjani has written in, he wants to know which debt mutual fund he should invest in, given the fact that there are so many different kinds of funds, keeping in mind specifically the fluctuating interest rates. He wants to know what strategy investors should have right now in the view of declining rates. Vishal, what would you recommend he does?
Anjani, for your query, I will try and rank order based on the tenor risk or the interest rate risk that these products take, assuming that credit risk is more or less similar between these products. So the longer tenor products like gilts and income funds will have higher interest rate risk than shorter tenor products like short-term funds or liquidity funds. And FMPs by and large don't carry that interest rate risk because they're not marked to market, they are supposed to be held to maturity. So that would be the sort of pecking order of high risk to low risk products in the range that you've given us. Now your second question around what happens in the current market situation, that really depends on the current yield curve. And in the current yield curve situation, both FMPs as well as short term or medium term funds might be quite well placed. Your third query about what happens in a when the interest rates are coming off, that's a time when the longer the duration on a product, the more advantageous it is. And that's therefore when a gilt fund or an income fund may actually work quite well in your advantage.
Last question comes in from Rajit, another beginner. He's 27 years old. He wants to start investing and create a strong portfolio for the long term. Vishal, obviously there are rules that we have for people who are just starting their investments. How would you recommend he get started?
Rajit, you've already taken the first big step, which is the intent is very clear. Now you could take the second step, which is to get yourself risk profile, because that would be the foundation on which you could base a long-term portfolio on. For this, you could actually sit down with an advisor or your banker, and they would help you assess how much risk you can take, how much knowledge you have, how much volatility in returns you could actually absorb. Now you're young, so I'm guessing that you should be able to take a fair amount of risk, in which case a regular savings plan in a diversified portfolio of funds may be a very good way to start.
All right, that unfortunately brings us to the end of the show. Vishal, thank you so much for spending time with us this week. Remember, any question that you have about your money at all, whether it has to do with loans, investments or just saving, write to us. Email ID is on your screen. You can reach me personally on Twitter as well. Thanks so much for watching.